We're good to go.
Okay, thanks, Kelsey. Good morning, everybody. May 6th, Retirement Plan Subcommittee meeting, and we'll get started with, what are we doing? We'll approve the minutes. Everybody okay with the minutes? Brett looks like he wants to make a motion to approve them.
I move that we approve the minutes.
Okay.
I'll second. All right.
Okay. All in favor of approving the minutes?
Aye.
Okay. Any opposed? Didn't think so. That's approved. Thanks very much. And I have no comments myself, so I'll just turn it over to Chris, I think, right?
Great. Yeah, I can get started. And hello, everyone. You can tell I'm in a hotel room. I am in Reykjavik, Iceland today.
Oh my gosh.
For business, actually, if you can believe it. And Tyler's, I think, in New York City. So we're remote but accessible. So I'm glad everything's working here. And good to see folks as always. So as we do each quarter, we'll unpack a couple of things. Certainly a lot to catch up on in markets. And, you know, the tone there has shifted pretty materially since the beginning of the calendar year. And we can kind of work through some of the reasons why. Governance on the pension side this quarter pertains to just an affirmation of the policy statement. We don't have any recommendations for the committee today, but we'll review that quickly. And then a little bit just on governance and all the good work that you folks do and a reaffirmation there. And then we'll obviously get into the portfolios and what transpired in Q1. So with that, And as of course, as I think as always along the way here, Tyler and I encourage questions. Let me see if I can make this work. If I do this, if I do, here we go. Make it full screen. Folks, I trust can see that okay?
Yep.
Okay. Well, good. So we'll make our way through here. Just so you know, I'm probably at fault here for skimming over this sometimes, but maybe a good reminder as much for me as the committee. But just if you're inclined, we are continuing, as you would expect, to put out lots of research around kind of various segments of the markets and clientele, and certainly retirement plans are featured, as you see there in the upper left-hand corner. So if you're inclined to get on our website, there's a lot of good collateral coming out regularly. We certainly continue to hire in front of growth and stay fully staffed. And you see some of our new associates joining us in the lower right-hand corner. And then maybe most noteworthy from this page, if anyone's inclined, we'd certainly love to have you in the fall up in Boston for our investor conference. And I think in Chicago last year had something like 250 people or something. So it's usually a great and productive day. So we'll keep you posted on that. We'll start just quickly, really very much a noted turn, as you all know, in terms of markets, and maybe we'll backtrack here a little bit. Certainly the overriding theme, as you all know, was the announcement of tariffs and the intention of the administration maybe to kind of rework the global trade regime and do so in a fairly material way and in a fairly short order form. And that is certainly, you know, had investors kind of digesting things in a wholesale fashion. Left-hand side of the page here, you'll see just a metric on consumer confidence. Consumer confidence as a data point is not particularly telling or has a ton of forecast power, but interesting nonetheless there. And you can see no surprise, right? Certainly with the announcement of tariffs, there's been a pretty material fall off in consumer confidence. And the notion where we were humming along at decent and consistent economic growth might be challenged now. So you've all read, I'm sure, this notion that the economy might slow down, and we're starting to see some data points on that to suggest that might be the case. And certainly that's the type of backdrop, right, that gets investors nervous and gets markets volatile. And alongside that, inflation, while down a measure from where it was 2 summers ago, the PCE number you see here on the right-hand side of the page continues to kind of be sticky or trend north of the stated 2% target. And I think, as you've all again read and know, there's been a bit of a tug of war between the administration and the Federal Reserve around the direction of interest rates. Certainly, the administration wants rates lower. Everything we've seen and read suggests that the Fed chair is not going to lower interest rates at the next meeting, and is concerned about just inflation being a bit higher, than they would like. So we've got this combination of nervousness around economic growth and patterns there, sticky inflation, and you can appreciate, right, that sets the table for mixed results in capital markets, as we'll see momentarily. Just to kind of maybe set the table a little more granularly, you see here a couple of big themes just in terms of what did happen in Q1. And this is particularly noteworthy, right? If you look on the left-hand side of the page, you see there a pretty disparate path for returns if you look at international equities versus their U.S. counterparts. And you see that gap out, and it persists even as we sit here this morning. I looked at some data before we jumped on, just to give you a flavor. Year to date, the S&P 500 is down about 2.9% through Friday night, I think. International equities are up close to 11%. So remember, we had talked for a long time about the predominance of U.S. equities. They were led, as you remember, right on the right-hand side of the page here, by the big hyperscalers, the tech names, the so-called Magnificent Seven, that were running at extraordinary levels, generating very strong returns and dragging the entire index higher. In addition to that gap that we've seen develop international to domestic, as you see now, we've had a bit of a cooling off of the big tech names. And those seven names, as you can appreciate, can influence things in the other direction as well. And even though under the hood there were good capital market outcomes or equity market outcomes for many of the constituents in the index, those big seven, were going to drag things down when they're not working, and we saw that in the first quarter. But there's been a measure of recovery in the month of April, but still pretty noteworthy that the difference in sponsorship about what's working and what's not. Overseas, just on a relative basis, right, you can appreciate there's been talk of the government's there more cooperative just around the policy backdrop and being a little bit more inclined to offer stimulus. There's been lots of talk, right, about the notion that Europe is going to start to spend on defense and the like, Germany in particular. And the Chinese continue to tinker with policy as well. And here in the U.S., obviously, right, we've been hostage to the tariff policy, and that's been front and center, and obviously been an immediate headwind for us. And then where it all came together in terms of returns for Q1, you'll see here again, I mentioned a bit of a mixed bag. Start to finish, interest rates were volatile, but when all was kind of said and done, spreads held in reasonably well, and base rates were well behaved enough where we did have a positive return. You see here for the broad investment grade fixed income market, up a little bit less than 3% for the quarter. And then square in the middle of the page for global equities, we had previewed this, right? U.S. equity markets down, both large and small cap, and then the international markets having the better of it, particularly the developed markets, up close to 7% in the quarter. We've got some exposure in the portfolios, as you know, to some of these diversifying assets like real estate, some of the other real asset categories, and generally they held up well, right? We've had sticky, uncertain inflation. We've had a backdrop of lower rates in the quarter. Those tend to be environments where these type of assets do well, and in fact they did. Let me pause there for a minute and see any questions from the committee on big picture stuff before we segue over to some of the portfolio details.
Just a quick question, and it's probably in there, but I just didn't see it or hear it. So year to one overall, I see where we are on each category. I can't see the screen. Does it show what overall? Are we down? Are we up? First quarter?
For the portfolios, Lisa, or
Yeah.
for I'm going to scroll just in seconds. Yeah, I'm going to come right back to that. I was just trying to give you the landscape big picture. And you folks can see my screen okay? Do you see the asset class return page?
Yeah, so
Yep.
Yes.
Good. Okay. I just want to make sure I'm not blabbering along here and you can't see anything. So we've got that, Lisa. I'll jump ahead here and I'll share that data with you in 1 minute. And if that doesn't satisfy you, obviously let me know. I'm going to skip some of this more detailed information. Excuse me, if you're inclined, you can, roll up your sleeves a little bit more under the undercurrents. So before we go to the portfolios, if you would, just a minute or two on governance. So this is the quarter where we just quickly reaffirm the policy statement, which we'll do. I think it's in good working order. No recommendations needed. I think Tyler will probably, although I think, Tyler, your governance last quarter, right? Your fees this quarter. So I'm going to jump right to policy. So just in terms of component parts for the policy statement, you see there we kind of tick off in your policy statement and draw that assurance that everything's in good working order. And from our perspective, the policy statements are in good functioning order. We don't have any recommendations to the committee to make changes. Again, I don't know that necessarily absent changes, this is something we need to formally approve. Maybe we just reaffirm it, but just wanted to get on the record that we think your policy statements are in good order and don't require any edits at this time. From a governance standpoint, a couple of pages here. I'm going to go to this one, and this is the season you'll remember as well, just at a very high level, what we think constitutes a good governance and oversight. And if you were to work your way down this exhibit, I think that you folks there at the town are demonstrating all of these kind of characteristics and processes, if you will. So you've got a well-functioning, attentive, credentialed committee that's weighing in on matters. You're meeting regularly. Obviously, Kelsey's putting together the packet and the agenda, and we're reviewing things on a regular cadence. So we think you're, from an oversight standpoint, in great working order, and no concerns there or anything to note. And then, Lisa, to your question, we'll use the town plan if it's okay as a proxy. You'll remember police and police and the other plan are all kind of following suit here in terms of what's going on. So for the quarter, about an inline quarter, you see there for the plans, up about 70 basis points, which about is what you see the broad markets did. To your question, Lisa, over the last year, you'll see the plans have gained about 6%. We'll see where we end up here in the quarter. It's kind of an interesting one. Quarter to date, bonds are down a touch, but equities are up, domestic too, in addition to the international markets continuing to run. So at our next print, of course, we'll have the fiscal year number through June, and we'll see where that gets us. But I think we're hovering around, actuarial expectations. And then the longer dated numbers, I know you've kind of grown accustomed to. Maybe it does kind of nicely brackets some of the COVID experience and whatnot. And I think the resiliency of your programs and the diversification, but lots of noise, right? Lots of indigestion, lots of challenges, but the portfolio's annualizing at close to 9% per annum net of all the manager fees. So I think from that standpoint, we're in pretty good order. Town plan detail here, just so you've got it, $30.1 million of invested assets. You see the roster here, and then the weights at the end of March versus the target weights, and within reason in terms of allocation, and no suggestions there. Just as a reminder, right? We are periodically warehousing cash at points in time just for pension payments, but that's monitored, and the level of that liquidity, right? It's kind of factored into where we stand with things. So no concern on that front.
Chris?
Yes, sir.
Yeah, just a quick question. So the growth for the first quarter is about 0.7%, and I thought I heard you say that we're on track to meet our investment assumptions. Is that right?
Yeah, well, yeah, I think, Bert, what it is, right? So it's not on the page here, but I could get it for you. So fiscal year to date, right? The 9 months ending in March, which is not depicted on this
Right.
page, right? But is running somewheres, at a level that would accrete to your actuarial return, right? We've got to obviously see what transpires here for the balance of the second calendar quarter or the fourth fiscal quarter, if that makes sense, right through June.
Yeah.
So that was my point there. And again, apologies. It's a little confusing because I don't have a data point alongside it. But we'll obviously have that number pretty early in July and can share it with the group. Hopefully, if things continue to stabilize, we'll have the makings of a decent fiscal year as well.
Thanks.
Good question. And again, right, in the interest of time, I won't belabor things. Right, by and large, there's small differentials in cash flows, but really over the long haul, not all that pressing. The Board of Ed plan here, you see again, the upper left-hand corner of the page, right? We won't go number for number, but certainly rhyming very closely with the town experience, and as you would expect, the allocation profile. Similar as well, and I think we were just at the point in the cycle. That's why you see the little bit of elevation in liquidity, because we're just preparing for forthcoming pension payments. The government fund, Allspring, is still yielding close to 4%, right? With the Fed kind of holding out on the front end of the curve. So money market rates are still pretty competitive. And again, we've talked in the past, you'll remember the opportunity cost to hold a little cash versus, for example, broad fixed income is not all that material at this point in time. So, you're not really being penalized all that much to hold a little bit of cash. So we've been just keeping the liquidity profiles of the program stoked for that very reason. And then police again, right? We won't belabor the point here, but upper left-hand corner of the page again, right? The numbers look, very, very similar to what we just chatted about on the other two plans. $22.4 million, again, an allocation schematic, right? That looks like the other two portfolios, a little bit of liquidity there, like we've got the other two portfolios. And then I didn't mention it, but I'll use this exhibit to do so. Up and down the left-hand banner here, just an affirmation back to the committee that all of the mandates are on maintain. Remember, that's our designation that things are in good working order, and our research team, doing their re-underwriting on a regular basis is comfortable with all the strategies, and they're kind of positioned and profiled as we would expect given the investing backdrop. So I don't think we have any concerns with the portfolios or the manager rosters themselves. So let me pause there again for a second, if I could, and then see, before we quickly segue over to the OPEB, if there are other questions from the committee on all things pension. Folks, okay? If something comes up, interrupt me, of course. So the OPEB, right, it's a little bit of a different animal. The allocation structure is similar, not identical, but similar to the pensions. But remember, here we use an all-indexed approach. And the numbers, are kind of rhyme with the pension plans, right? Again, they're not identical, but they rhyme with the plans. You can see here performance over time. Periodically, under the hood, when you look at some of the index strategies that are, and these are net of fees too, right? Some of the index strategies, there'll be tracking error in the short term, but that, as you can see over the long haul, kind of evens out. And as you would expect, you kind of get what the markets give you, right? And let the allocations kind of work on behalf of the trust. So again, it continues to grow, and it's in pretty good shape. $25.1 million of OPEB trust assets. You see here again, right? Certainly diversified. Certainly, right, standing allocations to fixed income like we've got in the pension plan, domestic and international equity like we've got in the pension plan, a measure of a diversifying asset with a REIT ETF to get a little bit of that exposure. Things from an allocation and a construct standpoint in good order. The one thing here that I think and I don't know that we need to unpack it today because I'd want to get you a little bit more information, but maybe for our next meeting, if the committee doesn't object, I might warehouse and ask for a little bit more discussion around the OPEB. We've had we've reviewed this in the past, right? Whether there becomes an appetite at some point to begin to introduce some active management here. We've used the iShares. Remember, they're kind of a legacy structure that kind of grew up in the old Simsbury Bank framework, which, as you all know, has kind of since moved away from us. So I think there's two things at work here that we should consider and talk about. One is I think we can get indexing in a number of these strategies in somewhat more cost competitive fashion, even though you're paying less than 0.2%. We could drive those fees even a bit lower using a more traditional index funds versus these ETFs. And then moreover, if there might be an appetite to introduce a bit of active management into the program now that you're at $25 million. So again, I would, through the chair, obviously, and not an action item for today, but maybe if no one objects, we do a little bit more work on this structure at the next meeting and continue to have that conversation if it makes sense.
Yeah,
I'm going to again pause and catch my breath and see what I missed or what I can help you with.
we can put that on the agenda, but I'm just curious. Like I'm looking at just these dashboards, and it looks like the OPEB, and I'm just trying to flip back and forth, at least like quarter date through 5 years, always has a better return than.
Yeah, it's a little bit, Todd. It's a good question. There's a couple of things going on there. The allocations are not identical; they're close. So there's a little bit of leakage from the allocation, and then there has been, probably in the case of a direct comparison, Barings has been an overhang for us, right? Barings has been challenged on the performance front through the last several years. They have since stabilized and are starting to turn in the other direction, which is fortunate. But I think that's been a little bit of a relative headwind as well. So it's selective. The pension plans, you'll remember, bear on a weighted basis about 42 basis points of expense. I mentioned earlier, right, the OPEB is at about 18 basis points. So there is a little bit of an additional lift and burden on the pension plans. It has been a tough time the last couple of years for active management, right? And we've talked about this. Remember, until recently, the complexion of returns was dominated by U.S. large cap, right? And nothing else was really working. And you've got exposure to large cap, as you should and would, and we endorse, as you know, but we've got exposure to other things as well, and we have that, right, because there are periods in the cycle, like we've seen year to date, where U.S. large cap is not predominant, right, and international does better. And in some of those markets, we do think with the benefit of time and full cycles that a measure of active management continues to make sense. So I noted the same thing. You're right. Certainly, point to point there. Recently, it's been a little bit of a relative challenge for the pensions, but not to a level, I think, or a persistency that would have us, running for that, the exits in any fashion in terms of the current structure of the programs.
Yeah, I think it's something we
could. No, but so noted. Yeah.
So we can definitely put on the agenda and talk about how to compare, especially on the expense side. What OPEB might look like with active management instead of just an indexed approach.
Yeah, and I think you would, if there's an inclination from the committee, we probably would leg into that very cautiously, right? I think we would want to work on maybe structure, driving the underlying fees down lower where we are indexed. I think we could accomplish a little bit of that. And then being very selective, right, with active management and just kind of bleeding that in very slowly and gradually to the program. Again, if it suited the committee.
Yeah, I'll see how anybody have comments on that, whether want to see that on the agenda for next time or.
Just one question. Looking at these returns, I guess, Chris, I would say, should we be doing more indexing in the other funds? Is that something we should also be looking at?
That's what, Lisa, right? That's what I would, that's again, right? We've had a very challenging environment for active management. I think an extraordinarily difficult one, right? If you didn't own the 7 largest names,
right,
in the upcap markets in the US, right? And we've got that exposure again, maybe just not to the magnitude that the index itself has. And again, that's by design. In the small cap markets, right? The manager we use there, Newberger, you'll remember, has disciplines around it. They don't own meme stocks, these non-earning meme stocks, right? That ran crazy at the back end of the pandemic over the last couple of years. They're just not going to own, right? And I think over the long haul, they have good reasoning and rationale around that. So it's been kind of a lack of it's not my professional term. It's been a quirky environment for active management and a challenging one. I don't think our research team, when they do that work, thinks that environment persists forever. I think you're right. We need to be measured and thoughtful with indexing, and I think there's a place always for it in the pension plans. We can debate maybe the magnitude over time, but I think it's a mixing and matching exercise, as it always is. And then when we need to take action, we take action. You'll remember not too long ago in the fixed income portfolios, right? We had to reposition that capital away from a couple of managers that had run into some issues. So we're certainly mindful of it and continuing to keep close tabs on it. And obviously, it'll do that in the future as well.
Chris, I think you said something to this effect, but could you explain for me as a layman just what made this a challenging environment for active management?
Yeah, I think a couple of things, Bert. One, U.S. markets, upmarket, or the big names, right? The extraordinary concentration of returns, right? You had those 7 names that we showed you on the page there, right? That were driving the larger indices. And we had that exposure, but when you look at the complexion of the market top to bottom in the US anyways, there was that level and general measure of concentration. And again, there was rotation into speculative names that the active manager we do have in the programs, their disciplines are their research is not going to take them to those non-earner names, those meme stocks that you've read about that ran wild. They just are not going to own that. And I think for good reason over the long haul. The international markets have been a little bit different, and their challenge until recently, right, had been the extraordinary strength of the US dollar, right? The dollar strength has been a big headwind for international returns. And the dollar, as you've all read, is weakened to good measure this year. And you've had that combined with good home country returns, and you see that switch, right? So that had not, kind of come into play until recently. So when we piece it all together, I think one is it's an acceptance that we're not going to have those super concentrated returns forever. We're not going to have that really speculative nature in those stocks running in the small and mid-cap arena. Nonprofit, no earnings, no cash flow, and just getting bid up crazy. That doesn't persist forever. And international markets, like we've seen to date, right, more recently, have their day in the sun, and we've got to stay positioned there, right, because it's just impossible to try to discreetly time those moves, right? Think about what happened right after the tariff announcement several weeks ago. In the heat of that moment, you'll remember the markets were under extraordinary stress. There were 2 or 3 days there where markets were down sharply. Our capital markets team was actually doing a lot of work on your behalf behind the scenes, just rerunning the allocations and recalibrating our expectations. Didn't quite get to the point of having to pull the trigger. And I say that because on the heels of that very acute 3-day downdraft, remember, we had one of the best days in the equity markets in 40 years immediately thereafter. And you can't time that, right? And you can't, and you don't want to, because if you miss that day, it annihilates your longer term returns, as you've all read and know, right? It's just, you've got to stay invested and you've got to stay disciplined with it. True to the allocations, continue to underwrite and keep tabs on the managers, as you folks all do, and we do on your behalf. And I think it gets us to a good place when things settle down. And again, the volatility we've had recently, our expectation is it's going to persist. And again, right, to try to time or be very discreet with the reaction is altogether impossible from our standpoint. So what do we know, right? We've got good diversification. You've got appropriate asset allocations. I think you've got a collection of thoughtful managers over time that'll be able to navigate things, and we kind of hang our hat on that if it makes sense.
So if I understand you correctly, in a sense, those market distortions, the concentration in the Magnificent Seven and the success of the meme set, that in a way favored the index approach because it drove up the indexes in a way that couldn't be matched by individual investments.
That's right, Bert. Yeah, I think that's right, Bert. Right, and it creates a vulnerability, right? Because we get seduced by how well the S&P 500 is doing, and when you look at the headlines, oh my God, the stock markets are going great. Yeah, the big seven are going great.
Yeah.
When you look under the hood at the other 493 names, it's much more of a mixed bag, right? And that story gets a little bit sheltered from just the idea that the index continues to go up. So there's been a couple of factors, kind of nuanced factors that we don't think will persist in the long haul. And we've seen that, in all frankness, right, play out in the new year, right? You've really seen what's going on with rates, what's going on with the pullback in the Magnificent Seven, what's going on with the meme stocks starting to come back to earth, and what's going on with good international returns. I mean, we are now, when we started the year, right, I don't think the narrative was the way it is, but we're now, approaching 13, 14% of outperformance for international equities versus the US, right? That is a big swing, as you all know. And it could persist here for a while, and you're positioned to take advantage of that, right? That by design. So hopefully, Bert, that helped a little bit. But
it did. Thank you.
Yeah, I would say that, I mean, it's probably worth the conversation in September, and that gives us another, 4 months to to see if there's more volatility in the market. The index fund might keep doing a little bit better than the management because of the volatility. I always think it's worth having the conversation if we have the kind of the data to show a comparison to kind of educate us. So we can talk about putting that on for September.
Yeah, no, I think, and those are all great. I was going to look at one last thing. Bear with me for 2 seconds. I'm just kind of on my desk here scribbling through. So I wanted to look at one thing. I don't know if I have it in this deck. I don't think I do. I think, Kelsey, it's probably in the bigger deck that we send you for the town record, but I just was looking at the individual active managers and their longer dated track record. And I think there's a true statement that most have been pretty competitive net of fee versus the benchmark. We'll have that data fleshed out for you as part of the conversation in the autumn timeframe. But I'm sorry, it's not in this particular deck. This is the summary deck we use. Anything else, Mr. Chairman, committee members, before Mr. Polk comes on?
Nothing from me.
Okay, great. Well, thanks for the good questions and the attentiveness. Always appreciated. Tyler, I'll defer to you.
Thanks, Chris. Everyone see the screen here, okay?
See it.
Perfect. I will talk about the participant-directed assets, and this quarter is a fee-focused quarter. So, again, given that town employees are paying this fee, it's very important that this committee, plan fiduciaries, make sure that understand all aspects of the fees that pertain to the retirement program, benchmark those fees for reasonableness, and then, of course, negotiate when those fees may be high, or evaluate opportunities for the lower costs. And I think it's very timely, given that over the last 3 weeks or so, the Supreme Court ruled against Cunningham and Cornell. Sorry, hold on one second. Hold on one second here.
I hope Tyler's not getting, he's in our New York offices today. I hope he's not getting kicked out of his, he might not have done the hoteling form correctly.
I think I was in the wrong office. I probably should be in the next one. We're good for right now. Okay. So given the timeliness recently of the Cornell Cunningham case, I think what happened is the Supreme Court ruled in favor of planned participants in that particular scenario, where Cornell was in a court case that essentially the plaintiffs were claiming that the fees were not reasonable with respect to record keeping, and the Supreme Court actually ruled that plan sponsors, fiduciaries, are responsible for proving that the exemption to pay record keepers is there. And so it's going to open up a lot of new cases, I think, with respect to retirement plans. You're insulated that you're not, $10 billion. And so obviously plaintiffs' attorneys won't be looking at this, but the idea now is that you're guilty until proven innocent with respect to paying record keeping fees. And you'll have to actually prove that those fees are reasonable, as opposed to participants and plaintiffs' attorneys proving that fact. So I think it'll make court cases pop up a little bit more with respect to record keeping fees. And I think it also shows how important this process has been. Obviously, ever since you've worked with us, we've had a process to benchmark every year. And I think, the movement that you've had, the RFPs that you've done over the years have further lowered those costs overall. So again, I outlined that it's important that we understand all aspects of fees, who's paying those fees, how they're paying, are they direct, are they transactional, and understand, again, are they necessary fees for, ultimately reasonable services. A couple trends that we're seeing in the marketplace. One is we're seeing more and more plans go to per participant models. So what I mean by that is, for record keeping services, it's often obviously a per participant business, a statement, a call center, a website. And so we have been seeing a shift over the last few years towards per head models versus asset-based. Your plan right now is currently paying asset-based fees. And when we look at the norm under 50 million, you're right in line with that. But when you look up market at the billion plus, you're definitely seeing a movement towards per head. 100% of plans that we see north of $1 billion are absolutely looking at a per head price for record keeping costs. I think obviously at scale, when you look north of $1 billion, that plan cost could be anywhere from $25 to $30 per head. But down market can be a little bit more pricier and a little bit bigger pill to swallow when you're doling that out. The other big trend, and you follow this trend, is what's called fee leveling, meaning everyone pays the same for plan costs, for record keeping costs. So obviously the investments vary, but everyone is aligned where no one, based on investments or revenue sharing, is paying a disproportionate fee for that record keeping cost. And so you are there, and you can see 92% of plans and 71% of 403B plans have moved in that direction. So that aligns very well with your current plan. So I said that it's important that you make sure that fees are necessary and reasonable. Of course, no one at the DOL or ERISA tells you what reasonable is. And so what we've done is put together a benchmarking survey, 622 defined contribution plans across the 260 billion in assets. In your grouping, it's this. We slice it based on size, because that really dictates often what the costs will be. But we also have it as an aggregate, and you'll see kind of how the fees change over time. But your plans are in the $1 to $20 million range. We go all the way, obviously, to $1 billion. The highest tier group is in that $100 to $250 million range. We also look at it as a function of participant count as well. So here's the outline of the fee review, and we'll just look at the 457 for now. You can see the assets as of the end of the year, the expense ratio of those investment options, and then that translated to dollars. And then if there's any revenue sharing in those funds, we outline that here on the right side. But obviously you don't see any revenue sharing. So from an investment standpoint, on the average weighted number, typically, again, it depends on where people invest, but it's roughly 33 basis points for the investment costs. And then, Mission Square charges 16 basis points for their record keeping services, to a total fee of about 49 basis points overall. So that again is the total fee, and then you can see obviously the record keeping fee carved out, but this is the all-in fee. We then do that for the Board of Ed plan. Again, same record keeping costs, slightly different allocation within the investments. So that's what's sort of moving the needle on the investment side. And then we look at the 401A, slightly different, obviously, movement with the and I think the bigger rationale behind that is just obviously more asset allocation to active management. But overall, the same record keeping costs. The one thing I will note in both the Board of Ed and the 401A plan is you do have a balance in the forfeiture accounts. You can see that reflected here. The balance in the Board of Ed plan was about $147,000. Again, this is people who've left the town and did not vest in their dollars. And so you can use those dollars to pay plan expenses, but you can also use those dollars for employer contributions. So note that those dollars are there in both the 401A and the Board of Ed plan. And next payroll, you can use those dollars to offset the employer or town contribution liability. I'll pause there, and I've been talking for a little while.
Just to piggyback off of that real quick, we are looking into how to apply those forfeiture funds to our payroll contributions too.
Perfect. Because as it continues to accrue, typically when you look at a plan audit, you want to sort of deplete those assets every year. And obviously it's assets that you can use. Kelsey, the thing to note is if people do come back, they do accrue back that vesting potentially. I would doubt that it would be that much there, but it is obviously good to use that to lower the payroll employer contribution over time.
Tyler, quick question.
Yeah.
Do you know if towns have policies on that? And could you share them with us if you are aware of them?
Yes. So that most towns, most retirement plans, there are three things you can use those forfeiture dollars. One is to offset the employer matching or employer contribution. The second option is to pay plan fees, be it audit fees, advisor fees, any expenses that relate to the retirement program. The third option is just giving it back to people as a sort of gift or a employer bonus. Typically, 9 times out of 10, forfeiture dollars are used to offset the employer contributions.
Are you aware of any written policies out there on this? That
It'd be in your plan document. So it would be outlined in the plan document, the options you can use. Also, almost 10 out of 10, those three options are listed as options.
Kelsey, could you email us a copy of the plan documents just so we can review that?
Yep, I'll get those over to you.
Thank you.
But yeah, those three are typically what are listed as the options to be used.
I don't want to spend too much time on this, but I'm struggling with the mechanics of the percentage versus the per participant. Like when you add participants, the individual fee should go down, but you're putting more money in. So it just seems like the percentage is just such an easier way to kind of administer it.
It is. There's been a movement in the industry that would argue that the work that Mission Square or Fidelity or any of the record keepers that are out there is the same for the number of participants and shouldn't increase as assets grow, right? Call center website statement. And so that's been this sort of shift to per head pricing. The problem, Todd, is often it negatively impacts more people than positively impacts by going to per head model.
Okay.
And there isn't anything that in ERISA or there's no lawsuits that say you should or shouldn't be in one way or the other. Again, our tax system is an asset-based system, so there isn't anything that says this is what you have to be doing. Right. But there has been a sort of movement towards looking at per head modeling.
Okay.
And what we can do, Todd, is ask the question, right? What would Mission Square be per head if we were moved in that direction? And then how many people would it negatively or positively impact? And so we can do that exercise for the next meeting if it makes sense.
So it's just the record keeping fees.
Yes, correct. The investment costs are always going to be
okay.
Asset-based fees. The record keeping is what we're talking about.
Okay, that makes more sense. I see.
Yeah, investment costs are obviously bigger balance, benefits bigger from a outperformance of the investment.
I'm having a hard time thinking about how someone with $1 billion in their fund could do the investment fees on a per head, but that the record keeping I get.
Yeah, because that's truly the argument is that's truly a per head thing. There's some liability. I mean, there's some argument that okay, if I had $1 million and there's cyber protection, right, and I made whole if that's breached, there's an asset-based function to that, but the argument is more that the $1 million balance doesn't get the gold-plated statement, right? It's everyone gets the same thing. So I did include.
Tyler, I'm sorry.
Go ahead. Yeah.
Question before you move on. Have there been some lawsuits in California? I think I remember reading about using forfeiture to offset employee contributions.
There has. So last quarter we discussed this.
Yeah.
So there's been arguments that using the forfeiture dollars to benefit you isn't in the best interest of plan participants. So the only option you should be doing is just giving it back to everyone as a gift. There hasn't been any ruling that is the case, Lisa. So no one's won yet, but that's been popping up. As I mentioned, that would be it would impact the billions of dollars of forfeiture dollars that are often used just like I explained. Right. So I'm not as worried about using it that way because it's the risk of you being sued or you saving the town $137,000. I'd be shocked if that would happen. One thing that Lisa that folks have been doing is changing the plan document itself to just say this is what we're going to use it as opposed to those three options I mentioned. And just say we only use it for offsetting employer contributions. So the other option isn't even written into the document.
Is that something the town of Simsbury should be exploring, and with whom should that be explored with?
That's so Mission Square holds the document. We can have a conversation with Mission Square. I could work with Kelsey to just get the language that's currently in the plan document. And if you plan to just use it to offset employer contributions, we can make sure that that's the only thing written into the document as well.
What sorts of things should the town consider in making that decision? Is there a decision-making framework?
Yeah, I mean, I think that the challenge is just what will you ever plan on using this for, right? If the only plan is to use forfeiture dollars and the intent of the vesting was always just to lower the plan expenses or lower the employer contribution and save the town money. The idea behind vesting is obviously someone hasn't earned those dollars and you get it back and then you can use it to contribute further or future employer dollars or future employer contributions. So that's the only thing you plan to do, why not just clearly outline that in the document?
Is that subject to union negotiation? Is this part of the negotiated, or I guess I want more information on the process.
Yeah, so I don't think that this is town-owned dollars. Vesting would be something that obviously is negotiated, I assume. So that's something that, but given that vesting is negotiated, that means that they're forfeiting those dollars to the town, right? So these are just dollars that people just didn't end up earning by longevity of working at the town. And I assume that was negotiated with the with the unions.
So Kelsey, I guess I would just ask from the town perspective, any recommendations that you make on either a policy or a change in the documents, that you just review it with our council and get back to us on a recommendation.
Okay, I will pull those documents and review them for any language regarding the forfeiture, and I will get back to you.
Okay, thanks.
I have a question about this because we've recently done some work on forfeiture accounts in the state DC plans, and one use to which we're looking to put really suspense account funds, not forfeitures, is to in self-corrections for missed deferral opportunities, where the employer has to provide, the missing employer contributions and also 50% of the employee contributions. Has our town run into anything like that? Is that an issue, and have we used funds for that purpose?
I haven't heard of, and you're absolutely right, Bert. That those dollars can be used for that, to correct any failed contributions or failed missed contributions. Be more a question for the Kelsey, the team, but I don't know of any.
We haven't come across any of those. Now that we have Crystal, who's on our meeting, welcome Crystal, our new HR generalist, we have a quality control process. So we're able to make sure that all employees are contributing, and that the town is also making their contributions that they're supposed to be making.
I was sure that would be the case.
But you don't have to unload. You don't have to use all of these forfeiture dollars. You can keep a buffer, and these dollars obviously continue to accrue. But it's important to know that these dollars are there. We did include some information around collective investment trusts. I don't see the savings to overcomplicate and add the paperwork yet. I think as we see the opportunity grow here, there may be opportunity to add in collective investment trusts. These aren't as simple as just lowering mutual funds. And so we'll keep you up to date on those. But I did include the benchmarking here. So you see the average weighted cost, obviously the 457, the Board of Ed, and the 401A. And then we include the benchmarks for a $1 to $20 million plan in different, slice it different ways. We look at it for other plans with active target date funds, the overall average, and then of course the record keeping fee. And so you can see, the record keeping fee at 16 is 10 basis points than the average for a plan to 1 to 20 million. So much lower. And then the overall cost, at least for the larger plan, is lower than or at and met and very close to the average for a $1 to $20 million plan. And we include some of the factors located down here. And then of course you get an idea of over time the assets and how they change. So 16 basis points is the average. Again, it's in the sort of close to the 25th percentile from a cost standpoint. And then if we also use a third-party average here as well in the box. So we went to Retirement Plan Advisory Group and got that average. And so you can see, much higher cost for the third party as opposed to just using our averages. 16 basis points actually is closer to $100 to $250 million plan in that and that sort of third-party average. And then we show you the range. So again, the larger plan is at 49 basis points. The average is at 53, and it can range from 1.65 to 16 basis points. I'll tell you, what gets a plan that total cost 16 basis points. Maybe the employer's paying those fees out of pocket, record keeping fees out of pocket, and they're completely indexed strategies that can occur. But I think overall, this in summary, your plan's benchmark really well, right in line with the average, no concerns from a fee standpoint. And so, we also include transactional fees here, which are in line with the benchmarks as well. I'll pause there. Any questions on the benchmarks? So the balances, obviously, with the market underperformance a bit last quarter, you see the market down a bit the 457 plan is at 18.4 million. Bulk of the assets in target date funds and the S&P 500. The Board of Ed plan is at 2 million, and then the 401A is at 1.8. So through contributions into the plan, we're seeing those assets grow. No recommendations to change the fund menu. All funds are on maintain. We don't, the target date funds are performing in line with expectation. Even in a challenged market, those funds have outperformed in the quarter and longer term in the top quartile. Rest of the managers are on maintain, and we don't recommend any changes to the portfolio. I will pause there. Any questions or comments I can answer? I know we're coming up on the 9 o'clock hour. Excellent. I'll pass it back to Todd.
Great. Thanks. Thanks both Tyler, Chris, and everybody. A lot more conversation than usual today with some of the things we're talking about. I have nothing else. We can talk about what goes on the agenda for next time. But does anyone else have any business before we close?
Just administrative. Chris, can we get you guys to come and do a full report to the Board of Finance in September, as is typical?
Yeah, absolutely, Lisa. I'll make a note of it.
Thank you.
Yeah, it's the 16th is the date of our regular meeting, Chris.
All right. In the calendar. Look forward to it.
Okay, thanks. Thanks. Anyone else? Okay, our next meeting is the 2nd, day after Labor Day, so everyone will be nice and fresh. And thanks so much for joining. Motion to close, adjourn.
So moved.
Okay.
Second.
Okay, that's great. All in favor?
Aye.
You got it. Thanks so much, everybody. Have a great day.
You
Bye,
too.
folks.
For over 40 years, SCM has been the voice of our town.
Bringing us together through
Local programming,
Education.
and live broadcasts.
SEM isn't just about television.
It's about empowering our community.
Ensuring our voices are heard during government meetings.
And celebrating milestones.
like our high school graduations.
But today, SEM faces a challenge.
Our funding structure is based on television subscriptions.
And it's no secret, people have been cutting the cord.
With a shift to internet-only subscriptions,
SEM receives less revenue.
Even though all our programming is freely available online.
We need your support.
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 Your donation can make a difference.
It will ensure that SCM remains open.
continues to educate our youth.
And keeps our community informed.
Thanks to SEM, I've been honing my creative skills, helping me work towards my college degree.
SCM is crucial for keeping our community connected.
SCM isn't just here to broadcast local events. They're actually preserving Simsbury's history.
Join us.
Join us in preserving Simsbury's voice.
Simsbury's voice.
Together we can ensure that SCM continues to thrive.
For generations to come.
Visit our website
Or scan the QR code on your screen to make your donation.
Every contribution
Counts.
Thank you for supporting Simsbury Community Media.
where your town
Your schools
and your government come together.